Welcome back to the Daily Crypto Roundup. Today, we're navigating a perfect storm of big moves across crypto, macro, regulation, and tech. And I'm going to walk you through 6 major stories that are shaping the space. Then we'll talk about what this means for you, how your portfolio might respond, and what to watch next. If you're listening right now, take 2 seconds to hit follow and drop a 5-star rating. It really makes a difference and keeps this independent coverage alive. Before we dig into the headlines, let's check where the market sits right now. Bitcoin is trading around $114,300, up about 2% in the last 24 hours after midweek volatility. Ethereum is near $4,075, up roughly 1.5%. Binance Coin is at $1,180. Solana at $203. XRP around $2.46. Cardano about 69 cents. Dogecoin at 19 cents. Toncoin around $6.38. Tron at 30 cents. And Avalanche at $23.10. The market is modestly recovering from recent duress, but we're still in a fragile phase. The move is real, but the test isn't over. Now let's roll into the stories that are driving things. The first headline: a major institutional signal. Evernorth, a company backed by Ripple Labs, has announced plans to list in the US via a merger and raise over $1 billion. Their business model? Accumulate the token XRP and build it as treasury asset capital. What you're seeing there is structural evolution. When a public company vehicle says, "We're going to hoard this crypto token," the narrative shifts from speculative software to asset class engineering. For investors, that means tokens like XRP can attract a different kind of capital: institutional, strategic, long-term. If you're holding XRP or considering it, this moves from noise into noteworthy. Next, the macro narrative thickens. A recent article delves into what's being called the debasement trade, the idea that assets like gold and crypto are rallying because investors fear fiat currency erosion. The kicker? According to the data, the dollar isn't collapsing. Yields aren't rising as you'd expect. Inflation expectations are moderate. What that tells us is the narrative may be ahead of the facts. For crypto markets, that means some moves are sentiment-driven, not fully backed by macro fundamentals. If you're trading based on the story that money printing equals crypto upside, you need to watch for when the story runs ahead of the data. When the narrative hits the gap, the move can reverse. Third story: regulatory risk is alive and well. The Financial Stability Board, FSB, has issued a warning that global crypto regulation still contains significant gaps. That matters because regulatory clarity is a foundation for large-scale institutional flows. If capital steams into crypto, but institutions believe the rules are unsettled or uneven, they'll price in a risk premium, or hold back altogether. So what you're seeing here is not just a market chatter item, it's a fundamental gating item. Portfolio defenders, pay attention. When regulation is foggy, upside may exist, but the downside tail is steeper. Fourth, let's zoom out to the broader market. The International Monetary Fund, IMF, has flagged the odds of a disorderly global market correction as higher than recent models assumed. Why does this matter for crypto? Because digital assets aren't decoupled. They often amplify risk asset moves. If global liquidity hiccups, if credit stress emerges, crypto's often on the margins of the first wave of exits. So your baseline assumption should be, upside exists, but downside insurance is essential. As a listener, you're not just watching token charts, you're watching macro gauge wires too. Fifth headline: geopolitics meets crypto. Trade tensions between the US and China reignited this week, and crypto responded. Bitcoin dropped below $110,000 when tariff headlines hit, and one study put liquidations in the leveraged crypto markets at around $19 billion in a 24-hour window. That kind of wipeout doesn't just affect leverage, it affects psychology. What this tells us is that even if you're focused on blockchain software or token utility, the market can still react like a macro hedge fund. For your portfolio, it means you have to watch big news, even if you own for the long term. Because when the big moves hit, they hit everyone. Sixth and final story for this part: technology risk quietly creeping back in. A security advisory this week says that state-sponsored threat actors in North Korea have embedded persistent malware inside smart contracts on major public chains. That's tech nerd territory, but for you it boils down to trust. If infrastructure cracks, tokens lose premium. If someone thinks your network can be compromised, risk premium rises. So even when you're thinking about scaling, staking, DeFi, and token utility, don't neglect base-level security, because it's silent until it bites. So those are your 6 big items. Institutional token accumulation, narrative versus reality in the debasement trade, regulatory structural risk, macro correction alarms, geopolitical shock tales, and tech/infrastructure risk. These all overlap, and what you're seeing now is the market trying to balance all 6. So recovering is possible, but navigating will require care. Let's pause and reflect on what this means practically for you. You've likely seen the bounce, or at least been aware of it. But the bounce doesn't mean the coast is clear. It means the market has given you a second chance. If you want to orient your portfolio right now, focus on diversification, size your bets, watch your leash. If you lean heavy into one token because this will be the next move, you're exposing yourself to more than token-specific risk. You're exposing yourself to market-wide risk. And right now, the risk map is broader than usual. When you strip out the headlines and look directly at on-chain data, you can see 3 clear phases unfolding this week. The first is what analysts call the flush, where leverage collapses after a shock. We saw that with roughly $19 billion in liquidations, as traders panicked over tariffs and macro noise. The second phase is the breathe, where spot demand slowly rebuilds from real buyers. You can see that in the rise of small wallet inflows to exchanges, which have ticked up by around 2% since Monday. And the third is the re-risk, when traders begin dipping back into derivatives to rebuild positions. That's starting now. Funding rates have turned slightly positive again on Bitcoin and Ethereum, meaning traders are paying to go long, not short. So what's fueling that confidence rebound? Partly it's policy. The Federal Reserve signaled that while rates will stay high through year-end, they're still expecting inflation to glide lower. That's not a pivot, but it's a promise of predictability. And markets love predictability. Analysts from Matrixport and Galaxy Research both said this week that consistent macro guidance can be as bullish as a rate cut because it lets capital plan. As long as the Fed doesn't surprise, risk assets can breathe. But confidence isn't just macro, it's behavioral. After a huge liquidation, many traders simply step away. Then when they return, they don't chase, they scale. That's why volume feels muted but stable right now. The ones who remain are the patient players, the same kind of money that builds bottoms quietly. If you've been in crypto long enough, you know the signs. Sentiment softens, memes fade, and serious builders start tweeting again. It's boring, and boring is good. Now, about the institutional side. The Evernorth story from earlier ties into something much larger. The gradual normalization of holding crypto as a balance sheet asset. In 2017, corporate treasuries treated Bitcoin like radioactive waste. In 2021, they flirted with it. By 2025, some are embedding it directly. Ripple's backing of Evernorth as a company that deliberately accumulates XRP isn't random, it's strategic proof of concept. If the model works, expect others to follow with Bitcoin, Solana, or even Ethereum. The pattern mirrors what gold miners did a century ago. Monetize your own resource base to finance expansion. It's not DeFi, it's corporate design. And for holders, that's bullish long-term. Every time an institution announces, we're keeping part of our reserve in digital assets, it takes supply off the open market. Remember, scarcity isn't just math, it's behavior. Meanwhile, the debasement trade continues to divide analysts. Raoul Pal and Lynn Alden have both commented this week that Bitcoin's correlation to global M2 money supply has weakened. In other words, Bitcoin's not just tracking liquidity. It's behaving like an independent asset again. That's huge because it suggests crypto might finally be maturing past its reflexive dollar down equals Bitcoin up logic. The counter-argument comes from JP Morgan's strategist Nikolaos Panagirtsoglou, who argues that liquidity still explains most of Bitcoin's big cycles. The truth probably lies in the middle. Macro liquidity sets the floor, but adoption and innovation set the ceiling. Let's not forget regulation. The FSB's warning about significant gaps has already triggered responses in Europe and Asia. The European Securities and Markets Authority announced it would fast-track secondary guidance under MiCA 2.0, clarifying how tokenized securities interact with DeFi. In Asia, Singapore's MAS reiterated that it will require additional disclosure for exchanges offering staking. The reason this matters is trust. Every time a regulator clarifies rather than bans, institutional money edges closer. Right now, crypto isn't asking for freedom. It's asking for rules that make freedom investable. Speaking of investable, let's talk about the money supply angle. Global M3 data shows expansion across most major economies, a quiet tailwind for risk assets. Historically, when broad money supply grows faster than GDP, liquidity spills into speculative markets first. That's why analysts like Powell have been calling this the stealth reliquefaction phase. If you're an investor, it means cash isn't scarce. It's just cautious. Once confidence resets, some of that cash will chase performance again, and crypto is often first in line when greed returns. The IMF's warning about a disorderly correction ties directly to this liquidity theme. If liquidity expands too fast or credit spreads widen unexpectedly, it could reverse the flow. In plain language, the more volatile macro gets, the more violently crypto reacts. But the silver lining is structural maturity. Derivative platforms are handling liquidation cascades faster. Stablecoins are proving resilient, and cross-chain settlement speeds mean contagion dies quicker. The system's shock absorbers are stronger than they were even a year ago. Let's turn to the security story, because it matters more than most people realize. The discovery of state-sponsored malware inside smart contracts might sound niche, but it's the digital equivalent of counterfeit bonds. If confidence slips, value evaporates. The good news is that blockchain forensics are improving just as quickly. Firms like Chainalysis and Elliptic can now trace malicious code deployment in near real time, and projects are responding faster. For you, the investor or listener, it reinforces one rule: own your keys, audit your contracts, and don't chase unverified yield. The moment you outsource security to hype, you've already lost. Now let's bring all of this together: macro stability, institutional adoption, regulatory evolution, liquidity signals, and security posture, and translate it into what you can actually do with your portfolio. The number one question people always ask is, should I be buying here? The honest answer? It depends what you mean by buying. If you're long-term, buying now is less about calling a bottom and more about catching a symmetry. If Bitcoin reclaims its previous high, the upside versus downside ratio still favors entry. If you're short-term, it's about patience. Wait for confirmation signals like steady funding, improving breadth across altcoins, and lower volatility indexes. Remember that markets are psychological machines. After every major wipeout, there's disbelief, then denial, then acceptance. Right now, we're somewhere between disbelief and acceptance. Disbelief because traders can't trust the bounce yet. Acceptance because they're tired of being scared. That's fertile ground for slow-build rallies. Several analysts are pointing to on-chain accumulation patterns, similar to mid-2020. Large holders gradually increasing positions while retail flows stay quiet. Glassnode's latest report shows Bitcoin's hodler net position change turned positive again, meaning more coins are moving off exchanges than on. That's subtle, but historically it's a precursor to bull phases. Meanwhile, Ethereum's staking ratio keeps climbing. Over 27% of supply is now locked. That reduces liquid float, which amplifies volatility both ways but tightens long-term supply. Solana's network activity has also stabilized, with daily active addresses back above 1 million, and transaction success rates improving after last month's validator upgrades. When you see these fundamentals holding up, even as prices wobble, it's a sign that builders are still building. As we close out this roundup, let's end with what analysts are watching going into next week. 1. US CPI data. If inflation surprises low, risk assets could get another push. 2. ETF inflows. Watch the cumulative totals on Bitcoin and Ethereum ETFs. Sustained inflows mean institutions are still buying dips. And 3. The geopolitical story. If tariff rhetoric cools, volatility could ease, giving markets breathing room. But if tensions spike again, expect another leverage flush. So what's the big picture? Crypto remains where it's always been, between chaos and creation. The same system that breaks itself also rebuilds itself stronger. Whether it's Evernorth turning XRP into corporate capital, regulators turning policy into participation, or traders turning fear into opportunity, the cycle keeps turning. Your job isn't to predict every headline, it's to survive every phase. Because survival in crypto is leverage. The longer you stay, the more asymmetry tilts in your favor. Protect your assets, stay diversified, and remember that every crash writes the script for the next climb. If you've enjoyed this breakdown, follow the show, drop a 5-star rating, and share it with someone who wants real analysis, not recycled hype. This has been the Daily Crypto Roundup. We'll see you at the top.